We are live. Expect a trade alert this Wednesday. We've been patient with a huge cash position that we're ready to put to work. So a lot of things have developed. Unfortunately, we missed a trade that would have doubled your money in about a week, which I was warning would happen. Everybody thought it wouldn't, but it sure did. And that was the cost of energy falling. So Russia's winning on all fronts of the war. There's no question. The sanctions are being completely bypassed by India and China, and there's no way the U.S. is going to go to war with China or India. Janet Yellen is allowing all the sanctions to be delayed. Laugh out loud. So long story short, we missed the chance to short NRGU. It's cut in half. Now I'm ready to go long Boyle and NRGU. They're both down substantially. We'll pull the trigger on Wednesday. There should be more to the trade alert than just that. I'm expecting the war to march on for another 30 to 90 days. I don't think Putin's going to stop at Donbass now. They're most likely will go to Odessa after that, maybe all of Ukraine, and then we'll hope he stops there. Long term, there's definitely about 7 countries he wants to take over to fortify Russia. But I do think there will be a ceasefire before winter approaches. Politicians have to end the war, or at least pause the war before winter, because they have not been able to reroute enough natural gas to keep the lights on for Europeans. And Russia is using natural gas as blackmail currently. So it's funny to see that oil's gone down so much, as now Russia's starting to cut off big countries from access. Now, we just took a huge gain on Boyle a few months ago, 305% profit. We're about to put that back to work. We've given up some profits that we had in the portfolio. Ethereum got toasted. It's down 50% in the last week. And we're going to be adding to that. That'll be part of the trade alert. Most likely going to rotate some of our bonds into Ethereum. And then we're going to take some of that cash, split it in half between Boyle and NRGU. That's what I'm looking at for high risk. For safe growth, similar, we'll most likely move the bonds into Bitcoin, and then we will move the cash into NRGU. That's what I'm expecting the trade alert to be this Wednesday. Now, our high risk growth portfolio returned 233% 2021. And usually after drawdowns, we have the greatest returns. This has been a hard year for investors, as stocks and bonds have been getting crushed. If you didn't have perfect timing in energy, you ended up losing a lot of money with that as well. In fact, if you were doing a momentum strategy in energy, you got toasted. In fact, you'd be down 50% in some of these assets just in the last week. So here's a look at the portfolio before we had sold Boyle. So we'll ignore this. We've kind of outlined what the trade alert will be on Wednesday. So get ready for the confirmation of exactly how to allocate capital this Wednesday. The first 115 trading days of this year is the 3rd worst in history. And you can see the return after such a big drawdown is almost always positive. In fact, of the top 8 drawdowns, all of them went up. So we don't know what's happened with 2022, but I think the pain is just about over, because we're seeing the energy costs start to fade, and now it's a great time to buy stocks and bonds. So there's a lot of cash on the sideline. The RSI reading on Bitcoin is at a all-time high. So this is a massive buy signal. There's a lot of people trying to short it below 20,000 because it can cause forced liquidations in a major hedge fund and a major exchange. So we'll see, but it doesn't look like they're going to pull it off. I think they're going to get short squeezed because they no longer have the macro, the bond market crashing to help the pressure on the crypto and tech side. So we'll watch that develop, but I believe now's a beautiful time to add to our cryptocurrencies. This is the largest destruction in wealth in modern market history. $16 trillion wiped out in half a year. Just remarkable. So what do we have to look forward to? Well, besides there being a great buy opportunity in bonds, stocks, and cryptocurrencies simultaneously, we have $705 million billion dollars scheduled for share buybacks in the coming year. So that's just a massive amount of stocks that are going to be shredded apart by corporations, reducing that supply. Retail sales are slowing down, and that is good for us to bet on growth outperforming value in the short term. So again, we were expecting a big slowdown so that the inflation comes down, so that the Fed has to stop being so aggressive. And that's exactly what's now playing out. Here's a look at the corrections of Bitcoin. And I want to point out this is one of the worst in terms of the percent decline. And it's also one of the longest. So there's only been 2 other crashes that were longer than this one. So I do think we are at the bottom. There's definitely a risk of some forced liquidations and some big funds still, which we're watching carefully. But when we look at the risk of it maybe getting cut in half one more time versus going up tenfold in the next few years, I like that risk reward ratio. Here's a quote from Jim Rickards that I screenshotted for us. The Treasury just released a Russia sanctions update that says all transactions prohibited are authorized. I'll translate the doublethink. Sanctions are announced, but the effective date is postponed. Okay, and again, that's because they're trying to get this inflation down. The sanctions just aren't working. Here's a look at the market cap percentage off the high. And I just want you to note, most of the time, Bitcoin is not going up. When it does go up, it leaps higher very fast. If you don't have your line in the water, you're not going to catch the fish. That's why we are buying into the dip, because we do believe in this asset long term. We're seeing demand destruction in trucking costs, as well as in shipping costs. And we're also seeing proof. Russia's economy grew 3% in the first quarter, and they hit a record exports of $93 billion in revenue. So their politicians are quite likely going to start reversing course here, realizing driving the cost of oil up is helping Putin win the war, not hurting him. This is a log scale of the price of Bitcoin, and I've lived through a bunch of these crashes. Every single time Bitcoin's going to zero, Bitcoin's dead. Retail loves to buy high and sell low. I'm telling you right now, you want to be buying into crypto. Everything we've been predicting is finally coming to fruition. I was a little bit early in predicting when the deflation would hit, but it sure is hitting now. Here's our look at the bond market. And really what you want to focus on here is what's the trend? The trend is interest rates go lower and lower over time. And this is because that's the way governments grow debt, which is now globally at about $300 trillion. There's no way on God's green earth they can allow all of the debt to be rolled over at interest rates above 3%. So I'm highly confident we're coming into a 2-year cycle of interest rates falling, which means you want to be betting big on cryptocurrencies and technology stocks and hedging your risk with energy stocks or with actually a long commodity position. And that's exactly what we're going to put in the portfolio this Wednesday, now that we've had that nice little sell-off. The 60-40 stock bond portfolio has had one of the worst returns in history. So you'd have to go back to the Great Depression to find a return of that level. So stocks and bonds have sold off viciously over the last year. 6 months for stocks, 2 years for cryptocurrencies. So that's really a remarkable time to buy both, and why we're getting so bullish leading up to next week. Now, everyone knows Fed hiking cycles tend to lead to deleveraging events. I want to point out we haven't even begun the hiking cycle. We did 75 basis points this week. The market responded favorably at first, and we had a big sell-off the next day, and now it's seems to be stabilizing. What we're really concerned with is, will the bond market stop crashing? And so what we saw right away is the 2-year yield started to fall. We're getting energy stocks to fall. We're getting the price of oil to fall. And so this could lead to a more dovish Federal Reserve towards the end of the year. I still expect a 50 to 75 basis point hike in July. And I think the markets will like that because the Fed's so behind the CPI. So this is actually most likely a very good thing. And again, if we look at what's causing the high inflation, it's rent and it's transportation and energy. So as long as we can stabilize the price of oil and slowly get it to drift lower, It's going to be a pretty good setup for, again, tech. Here's a look at container ships. Costs also crashing, as well as lumber futures. We've had a slowdown in retail. Everything is pointing towards essentially a slowdown, which is good again for bonds and tech. Now, the Michigan Consumer Sentiment Index hit a low. That typically marks the bottom of a recession. So most likely people will look at the last 6 months as this being a recession. And I believe if we, again, can get these energy costs come down, sentiment's going to go up moving forward. Now, we were warning you about a sell-off in energy. And one thing that was interesting was looking at the insider selling, hitting a record level. And then sure enough, XLE's been crushed lower, giving us a great new buy opportunity into next week. So I'm going to skip through the exact trade alert recommendations because that will be adjusted on Wednesday. But bottom line, we're going to move our bonds into crypto. We're going to move our cash into energy and be set up for a really balanced portfolio for the remainder of the year. We'll skip through this a little bit. Here's the big trend in bonds. Unless we're going to have a complete paradigm shift in the way governments run their budgets, the long bond has to go back down. Otherwise, the whole system collapses. And I can tell you what, the Republicans and Democrats have zero intention of running an account surplus at the government because it's not physically possible with all the promises that we've made to investors. Now, here's the Fed's track record of getting commodity costs down by doing financial tightening. It almost always works. Some cases it's taken a few years to pull off. We know what the main catalyst will be to get the sharp decline in commodities. It'll be some sort of peace deal in Ukraine, but I'm just not seeing that being around the corner at the current time. And that's because Russia's currency is becoming stronger. Their exports hit a record, and China and India are not following these sanctions. In fact, our own government's now secretly telling people to bypass them because they're worried about food shortages and fertilizer shortages in the coming year. So this is what caught us off guard, why we've had some pain in the portfolio. The bond market crashed at a rate that is something like 1 in a million, extremely unlikely, a 3 sigma move. It's never been seen before in history. Nobody I know predicted such a quick crash. It went a little bit further than I thought possible, and it did it in 6 months instead of 2 years, which is what I was expecting the time frame to be. So with very high speed algorithmic trading and big hedge funds, they predicted the inflation, they shorted the bond market, and people made a lot of money doing that. The question is, will the bond market keep crashing, or is the move over? And I believe that move is over. This is the longest bond market crash. Now, again, the last few months were the vicious part of it and the greatest decline. Once again, we're seeing massive inventory builds at retail. So they're going to have to start discounting this and getting it through the store. So we're really looking at quite a bit of deflation coming through. If we look at exports and PMIs, all the leading indicators from China, Germany, and South Korea are pointing to a global slowdown. Now, I'm not seeing a crash, I'm seeing a slowdown. We'll look at the data, but once again, not predicting, the next Great Depression or a 12 to 16 month bear market. Here's the US jet fuel prices hitting record highs. And again, they can get to these levels, but they do not stay for very long. We hit a local record in oil in euros and pounds, not in the dollar. And once again, this is unsustainable price action. Here's export and import prices. It can get to these levels, but it can't stay there for very long. So predicting the inflation was one thing. You did that by being long energy or shorting bonds, and we did well with that. Now we're expecting the exact opposite to run through the economy. Now, if it doesn't, if oil continues to go back up towards 130 to 180, I do think it'll crash everything and take the bonds a good bit lower. So we're watching that carefully, but at this point looks extremely unlikely. So once again, we will update the exact ratio of stocks this Wednesday. Monday, the markets are closed, and get everybody rebalanced. Massive short positions that could be squeezed in both tech and crypto. So beware. The opportunity for a short squeeze in tech is massive right now. We could see some very quick returns. What else is going to be driving investment into cryptocurrencies? Well, it's basically the expansion of debt. And right now we have Japan doing yield curve control. There's a lot of money trying to pressure the yen lower and their bond market lower. And they have been basically saying they will spend an unlimited amount of money to cap the bond yield on their government debt. And so far that has worked for them, but we're seeing the weakness in the currency. So massive money printing occurring. Here's the return of one of our favorite tech assets, Bitcoin. And so just want to point out, yes, there's always a risk for more downside, but the upside is so massive that right now we believe this is a great time to double down on your cryptocurrency positions. This chart says don't look at the highs, look at the yearly lows. There's only 1 year where cryptos have gone lower year over year. That was 2015. That's when China's real estate bubble was crashing and they had to bail it out. So we saw sell-off in stocks and China, emerging market stocks. But what happened shortly after is the US went into a tightening period where they're raising interest rates 2016 to 2018. And China went on a printing mania to bail out their real estate market. Exact same things happening right now. And even though there was some pain in 2015, by 2016, 17, and 18, you made 20 times your money by buying the low. So if assuming we're at the low today, we could be having some substantial returns in cryptocurrencies over the next 2 years. Okay, so we got Japan and China essentially printing money while the US is trying to fight inflation by tightening monetary conditions. We're seeing the weaknesses occur in the Chinese yuan and the Japanese yen. To really get the spike for Americans, we need to see the dollar go down. That's going to happen as the Fed begins to soften its hawkish talk, which they're going to do as energy costs fall. So that's going to make the dollar go down and tech stocks and cryptocurrencies go rallying right up. The trade that's now exciting for us to hedge the tech position, in case I'm wrong about the inflation, is to go back long BOIL and NRGU to protect our tech positions. So that's the plan going into next week. And what a vicious drop. So I wish I had had the courage to tell you guys to short BOIL. I did my personal account, but while I was watching the war ramp up and the rhetoric get worse and worse, it just looked too risky. Now that it's back in the 68 level, I feel highly confident to put you back into BOIL on the long side, along with NRGU, and double down on our cryptocurrency position. So the next 6 months should be very, very profitable for our portfolio after a 6-month period of pain. Here's NRGU falling just massively from as high as 800 to 378. And big picture is we have a huge energy crisis over the next decade. We'll be in and out of NRGU for at least the next decade. That's how long these super cycles tend to last. Here's oil starting to sell off. Everybody thought that was impossible with the war raging on. And now we're seeing a decent sell-off. I would get super bullish if we could go below 100. I think with the war, we'll be very happy to see it bouncing between 100 and 115, maybe as high as 120. As long as it's trading in that range, I don't mind being long NRGU and getting more aggressive on crypto. If we see it fall below that, I believe the war would have to end, and then we go super aggressive into cryptocurrencies and tech stocks. So why are we at war, and what's Russia trying to do? Well, NATO's been encroaching on their border, and now Russia's fighting back. It's really just a fight over resources, and it's as simple as that. Now, the problem is Russia doesn't want to just take Ukraine. They want to really take back a lot of the red territory. So this could be a very long war with periods of peace in between. Last time the US tightened while China expanded credit, Bitcoin went up 4,400% and DXY fell over the main ramp up. And that's exactly what I'm seeing is we're going to see energy costs fall. Now imagine what's going to happen to energy costs once the Republicans potentially take over the House and Senate this winter? Well, the expectation to ramp up energy production and refinery is going to definitely put downside pressure on energy. So I do expect the next 2 years to be absolutely beautiful for a weaker dollar and a skyrocketing cryptocurrency. Okay, so if you want to not miss out on a trade alert, call Dean at 322-7515. So I'm looking at questions. So Don says long energy. Yeah, we missed the crash. It crashed over 50%. So I didn't pull the trigger on it. Okay, Harry says Ray Dalio shorting. Yeah, okay, guys, but Ray Dalio runs a $200 to $300 billion fund. So a $5 billion short position is a hedge. It's not a bet on stocks going down. Armand used coal during the Boyle crash. Sweet. Good for you. I did as well, but I just was not confident enough to give it out to everybody. There's no inverse for ETHE, and I would not dare to short Ethereum right now because it could be short squeezed dramatically higher. Okay, let's look at the data for today. Okay, so here's that bond market. This is the move that caused all the pain that we did not accurately predict. I'm now predicting this will top out and fall for about a 2-year stretch. And the only thing that would change that outcome would be oil going above the recent high and staying above it, which I only think would happen if the Europeans and the US actually wanted to block China and India from buying Russian oil, which I don't think they're going to do that. Here's a look at the TLT. Again, I believe it's going to stabilize here and start to go up. I like bonds, but I like cryptocurrencies far better. So I look at crypto as a super aggressive tech bond play. Here's the mortgage rates, just extreme move higher. Again, I believe these will top out and fall. Here's the yield curve over the 2 and 10 year. It's not steepening. We'd be much more worried about a recession or a depression or a bear market if we were seeing this steepen, and it's just not doing that. Here's a look at the yield curve. We now have most of US debt trading over 3%. So there's just no way we can roll over $30 trillion of debt at 3% interest rates. In 2 years from now, I'm extremely confident we're going to see far lower interest rates. As far as the July meeting, I expect a 50 to 75 basis point rate hike. And I bet it's going to be primarily based on where energy's at. So we'll see where that's trading around that. But either way, I think the bond market will want these rate hikes in the 50 to 75 basis point. There's a lot of money sitting on the sideline, $2.2 trillion. So this could be flooded into bonds or stocks. And so right now it's just sitting in the reverse repo. That's a QE buffer. If we look at the gold to copper ratio, gold is outperforming copper, predicting lower yields. This is what we're warning you is that we're ready for a sell-off in energy. It happened. It happened super fast. So now is the time to buy the dip because the war is not ending. And now we have great prices to get back in on this. So you can see this just vicious crash being led by insiders on the big oil and gas companies. Now remember, lumber futures was predicting this just like it did last summer. And now we're starting to see that sell-off develop. So Wednesday, I will pull the trigger and increase exposure to crypto, to tech, and to our hedge against inflation. Here's a look at DXY going straight up here. This is being mainly because the Japanese are printing lots of money to protect their bond market. and this is causing their currency to devalue against the dollar. Also, the US is a huge exporter of energy. So as long as energy is sticky, we're going to see that dollar remain strong. As energy costs come down, expect DXY to fall and for crypto and tech to boom. Here's a look at the Japanese and Chinese currencies. You can see they've been devaluing against the dollar. It's causing a lot of money printing to occur in these countries. Now, if you do want to get a more aggressive play into crypto, uh, look at this top applications that have been developed on the Ethereum protocol or operating system. I look at Ethereum as a ripoff of Windows for decentralized applications. And so we like AXS, SAND, Mana, Matic, and Aave, along with Uniswap. And they can outperform Ethereum by just massive, massive magnitudes. So if you're interested in the private equity offering we have, it's only for paid members. Call Dean. Right now is a great time. Yes, there's a risk we see some of these big funds blow up and go lower, but there's also a risk of those people trying to short sell the market getting caught off guard as yields fall, energy costs fall, and a massive short squeeze hits tech and crypto simultaneously, which I think we are finally at the doorstep. Okay, here's a look at the big macro parts of the market. So yellow are interest rates, green is energy, the pink line are banks, and then the black is the NASDAQ. And so what's important to note here is the banks and energy are going down as interest rates fall. That's our signal to go long tech. And so that is behaving how we would expect. In this chart, we're comparing emerging markets to the S&P 500. And we're looking to see if emerging markets are about to outperform the S&P 500. Prominent investors like Ray Dalio and Jeffrey Gundlach are expecting the dollar to fall over the next decade and for extreme outperformance in emerging markets. We're talking 10 to 1 the returns, as the US is going to have much tighter spending habits to cool off inflation, and as China turns up the printing press to hit their GDP targets. And it's a lot more in depth than that. But essentially, China manufactures everything for the world, while the US has lost that. So there's just a much stronger economy growing out of China than the US. In this chart, we're looking at Alibaba, Tencent, and Taiwan Semiconductors. And we're looking for the Chinese stocks to greatly outperform to signal that the government's not going to be throttling its own tech center, which it has done for the last year. And so we're starting to see that great outperformance with Alibaba up 23%, Tencent up 10, and Taiwan Semiconductors down 5 over the same trading period. Here's the short that Ray Dalio's built that's being advertised, but remember, that's a hedge against a huge stock position. So Ray Dalio is not exiting stocks, to be completely clear. So we're around the middle of the price action in the COVID crash. Okay, so we have a small position in our safe growth portfolio, and I might potentially use that to double down on Bitcoin for the safe growth portfolio. That's actually a position I was looking at, and because I don't think the war is going to end anytime soon, it might be a smart way to reallocate some capital. This chart, we're looking at some alternative energy sources: copper, rare earth metals, and uranium. And we'll zoom in on the recent bull market activity. They're all trading in a very similar return. And so no plans to sell that. We have exposure to rare earth metals and uranium in the safe growth strategy. And I do see us holding this long term. So to get the climate change agenda going, there's going to be a massive demand for the products of URA, COPX, and REMX. Now I look at rare earth metals as a more leveraged version of copper miners. So just watching to see if there's any breakdown in that correlation, but really no need to own both. In this chart, we're looking at silver, gold, and the bond market. And so we've seen silver and gold go up with bonds and then go down with bonds. In general, not seeing any reason to reallocate a lot of capital to gold or silver right now. I still see massive job openings with not enough workers. So I don't see a dead economy coming up anytime soon. Here's the core inflation, which we did predict would fall. And so I believe this trend will continue. It's going to be a Goldilocks situation for stocks if this continues. And the main thing holding it back is food, energy, and rent, which again, as long as these bond yields can cool off, energy costs can cool off, are going to come into play on its own. We'll probably see housing sell off a bit with these high interest rates, which again will cool off the inflation data from rent. Here's the jobs, they keep piling in. This is very healthy jobs growth. So unless we see this drop substantially, I'm really not worried about the economy falling off a cliff anytime soon. There's the labor force participation rate. If we really want to believe there's going to be sticky inflation that's running at above target, I think 3%, anything above 3 to 4% for too long of a time period would create massive problems for stocks and bonds. But the last time we had that sticky inflation was in the 70s. And look at what labor force was doing. It was going straight up. We had so many jobs coming online that it created this long-term inflationary pressure. We've already seen the labor force participation rate flatline. So we're kind of just turning over jobs right now. We're not actually creating new jobs. Banks continue to grow credit, and they have really beautiful interest rates to use right now. So this keeps growing at a very substantial clip. Consumer continues to borrow. Even though the savings rate has fallen, the debt to GDP is not that bad right now. So I believe consumers are not tapped out and will keep on growing that debt. So this leads to lots of profits for corporations. Here's that slowdown. And so once again, we just hit a record high on retail sales. So it's slowed down, but it's not crashing. And this is what we want for being long tech stocks. Here's consumer spending hitting a new record high. Trade balance, sure, it's cooling off, but we're still importing a lot more than we export, which will lead to a weaker dollar as we export dollars to import goods. Here's the home sales. Sure, it's falling, but once again, I believe we're going to see housing cool off, prices fall, and we'll probably see a pickup in housing sales. So not seeing some sort of real estate collapse right now. China's PMI is bouncing back up after they locked down the country for several months. Their exports are picking right back up, and their imports are picking right back up. So here's a look at the Fed balance sheet. They're talking about selling $100 billion of bonds per month for a couple of years to get this back to 6 trillion. We'll see if and when they get anywhere near that. But I believe as the inflation falls, we're going to see them go from this super hawkish talk to a lot more accommodative policy. So we'll see how that plays out. But we're just at the very, very, very beginning of this tightening phase. Meanwhile, other central